Greetings, everybody. Welcome to Liberty Call. I am Raymond Dahlman, your humble host. Today is Tuesday, June 13th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It is another dreary day here in Colorado. I don't know who I need to talk to, maybe the governor or Mother Nature or something, but there's a deer in my drive, or in the secondary driveway here in my house. So he's munching on the grass, it looks like. So anyways, I'm glad you're here. If it's your first time watching Liberty Call, please give me some thumbs up, likes, shares, subscribes, follows, all that good stuff. I would greatly appreciate it. Well, let's go ahead and jump into the numbers. People seem pretty happy today. The Dow Jones was up 0.43%, 145 points, closed at 34,212. S&P 500 was up 0.69%, closed at 4369. NASDAQ was up 0.83%. That was really the big gorilla pulling the market up today was the technology stocks. It was up 0.83, closed at 13,573. The VIX was down 2.66%. It's currently holding at 1461. Canada was up 0.35%. Brazil was down 0.51%, and Mexico up 0.56. Over in Europe, Germany was up 0.83%. The UK was up 0.32%. France was up 0.56%, Netherlands was up 0.97%, Spain down 0.11%, Italy up 0.57%, Switzerland up 0.23%, and Portugal up 0.22%. Russian exchanges were mixed today. The MOEX was up 1.82%, the RTSI down 0.16%, and all green in the Asian markets, starting with the Nikkei in Japan. It was up 1.8% yesterday or today. Australia was up 0.23%. New Zealand was up 0.9%. In China, the Shanghai was up 0.15%. The Shenzhen Component up 0.76%. The China A50 up 0.38%. DJ Shanghai up 0.26%. Hang Seng up 0.6%. And the Taiwan weighted was up 1.54% for the day. So, I mean, I guess, well, the overnights in Asia, they wouldn't have had any of the CPI data that came out early this morning. I think about 8:30-ish. The CPI data came in right at 4%. I think we were guessing around 4.1. So some people are thinking that's good news. I don't know. I mean, it seems to me that the inflation is still pretty hot, but, and all the other data that we look at is still not all that fantastic. All righty, let's go ahead and jump into the market recap. S&P 500 rises as slowing inflation bolsters Fed pause bets. Fed meeting underway. I wonder what they're talking about. All righty, let's jam through this real quick. The S&P 500 advanced on Tuesday as data showing inflation slowing to more than a one-year low, boosting expectations for a Fed pause on rate hikes just as the central bank gets underway with its two-day meeting. The consumer price index rose 0.1% in May, in line with expectations, following a 0.4% rise in April, marking the 11th straight month of cooling price pressures that took the year-over-year figure down to 4%, down from 4.9% the prior month, and the 11th consecutive month of cooling price pressures. I mean, what really happened was the really high data fell off the back end. And that's why it doesn't look nearly as bad. So cooling CPI data out this morning drives the ongoing narrative of a Fed pause ahead of the FOMC tomorrow, Janie Montgomery Scott said in a note. All righty. Following the data, bets on a pause were nearly fully priced in at 95% compared to with about 81% a day earlier. The odds of the Fed resuming hikes in July, however, also ticked up to 60% from 50% a day earlier. And this is something I was talking about with a client earlier today is that, if the Fed, pauses this month or next month, they're probably going to raise rates, either, tomorrow or at the July 25th and 6th meeting. So, it's, kind of, 6 in one, half dozen in the other. I mean, it's, one of the two things is going to happen. I do not expect a rate cut. I just, the data doesn't really warrant it at this point, but, we shall see. All right. Is there any other good data here that, now I'll skip over that. All right. Next up, U.S. consumer price inflation, price increases slow. Underlying inflation is sticky. U.S. consumer prices barely rose in May, and the annual increase in inflation was the smallest in more than 2 years, though underlying price pressures remained strong, supporting the view that the Federal Reserve would keep interest rates unchanged on Wednesday while adopting a hawkish posture. The smaller than expected rise in the consumer price index reported by the Labor Department on Tuesday reflected decreases in the cost of energy products and services, including gasoline and electricity, but rents remained sticky and prices of used cars and trucks rose further. The report was published as the Fed officials began a 2-day policy meeting. Quote, the moderate slowing provides the Fed room to pause its rate hikes this week, end quote, said Kathy Bostensick, chief economist at Nationwide in New York. Quote, however, if economic data continues to surprise to the upside and inflation remains sticky, the door is open for another rate hike in the coming months as soon as July, end quote. The CPI increased 0.1% last month after gaining 0.4% in April. Gasoline prices dropped 5.6%, while electricity declined for the third straight month. Utility gas also costs less. But food prices rose 0.2% after being unchanged for 2 consecutive months as fruits and vegetables, non-alcoholic beverages, and other food products became more expensive. Meat and fish, however, were cheaper, while egg prices fell 13.8%, the most since January of 51. It also cost more to dine out. In the 12 months through May, the CPI climbed 4%. That was the smallest year-on-year increase since March of 21, and followed a 4.9% rise in April. The annual CPI peaked at 9.1% in June of last year, which was the biggest increase since November of 81, and is subsiding as last year's large rises drop out of the calculation. I just said that. So, all right. So that's all the news there. Was there anything else in this article? I didn't do a summary because I was in a meeting with TD Ameritrade and Schwab, and they're doing a conversion later this year. So, nothing to concern yourself with today. All right, so I think that's about it. Got one last article here. Default by inflation is the real drama in the global market. We'll touch a few of the paragraphs here. The real drama of default in global markets has not been the federal debt ceiling negotiations in Washington, but the write-off by inflation. The issue of whether it turns out that the U.S. Treasury for weeks has been slow in servicing its debts, with all the delays subsequent rectified, is a sideshow. We could regard this as camouflage for the ongoing real write-off operation in this countries led by the U.S., where a great inflation emerged during the pandemic and Ukraine war, have achieved big reductions in real value of their debts. The governments have also gained from a reduction in the total nominal market value of their fixed rate debts due to a rise in interest rates. Those gains do not show up directly in national accounts. Rather, they are opportunity cost savings. Governments will not have to pay the prevailing higher level of interest rates on the part of their debts, which are fixed rates form until far off maturity dates. The savings for government shows up in investor wealth statements and balance sheets insofar as they are based on present market values rather than fictitious historic cost. As long as the losses on government bonds are held by the central bank, there is no benefit to big government. It's all a wash in consolidated accounting across the public sector as a whole. The real write-off by inflation occurred without any political wrangling fettered by indeterminate commentary in the financial media. The dance of high inflation stakes has occurred, featuring the central bankers, politicians, and their cronies. The first and biggest dance was when the Fed stuck to its zero interest and quantitative easing policies through the first 2 years of the pandemic, 20 and 21, citing with great confidence its central scenario of transitory inflation. The Fed was silent and dismissive about the alternative possibility scenarios. Chief Jerome Powell told us with great aplomb that the Fed was not thinking about when the decision should begin on lifting interest rates from zero. Incredibly, at least in hindsight, the Fed announced its new framework of, quote, flexible inflation targeting, end quote, in August of 20, already well into the germination period for the great pandemic inflation. The idea was that higher inflation for some time in the future was welcome to make up for the long years of inflation less than 2% target during the 2010s. Big government in all its branches alongside powerful outside interests, including private equity barons, who would benefit from the reduction in real value of their debts in a shock outbreak of high inflation, happily tolerated the complacency. The same choreography has played out in high inflation countries of Europe, including the United Kingdom, Italy, France, and Spain. Yes, there was some resistance within the European Central Bank from Germany and Holland, but mooting this was a general concern in its policy to avoid a return of European debt crisis. Remember, as late as July of 21, the ECB rolled out its new monetary framework of quasi-flexible inflation targeting a year later than the Fed, albeit in a greener, less explicit form. The message was that the ECB was more tolerant of inflation overshoots than undershoots, as it was harder to get inflation up than down. Well, we figured that out. Japan and Switzerland have been outliers in the dance of default by inflation. There has not been a real write-off in Japan or Switzerland or on anything like the scale of high inflation countries. Over the 4-year period from 2020 through 23, the estimated fall in purchasing power of domestic money has been around 17% in the US, 20% in Italy, 5% in Switzerland, and in Japan. In Switzerland, the low public debt to gross domestic product ratio, around 40%, means that big government would not join in the inflation dance with the central bank. In Japan, it's quite the opposite. Japan's crushingly high public sector means that there is visible danger of the government and the national diet joining the Bank of Japan in a dance. The musical theme would be high optimism about future inflation despite continuing very low interest rates. The collapse of the yen against the Swiss franc reflects the specter of eventual real default by inflation in Japan. The yen Swiss franc exchange rate has soared from 112 on the eve of the pandemic to 153 now. So, all right, there's a few more paragraphs, but we'll go ahead and stop that there. Essentially, because we've inflated the economy, those debts have stayed the same size, and you're paying it off with inflated dollars. So any debts that are at a fixed rate, let's say, like my mortgage, I bought this house 6 years ago at somewhere around 3%, and it was around 500,000. So the the mortgage payment all in was about $3,000 a month. So that being said, if inflation goes up, and there's more dollars in the system, you're able to then pay off the debt, which has stayed static, with dollars that have inflated. So anyways, that's kind of the big story they're trying to tell there. But anyways, we've created a problem. I mean, yes, it helps out people who have tons of low interest debt. They can pay it off with the inflated dollars down the road. And I think that's kind of been the game plan of the United States all these years, is to continue to slowly grow the debt. And the hope is that the GDP will go way up, and then they'll be able to pay the debt off at some point in the future, in short order. But anyways, I just don't see that happening. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.